Welcome. My name is Wanda Rochelle, and I want to welcome you to my channel. I am your licensed realtor and probate expert. I'm so excited today to talk about a topic that I think is very much needed, and that is just to say, in a joking way, how to flip your grandmother's house. Because I get a lot of my probate clients who have a loved one that has passed away, and they would love to know how to flip the house themselves. And so I have a special guest with me here today. I have Mr. Emmanuel Blakemore. And if you want to go ahead and introduce yourself.
My name is Emmanuel Blakemore. I'm broker owner of Blakemore Mortgages. We do everything from residential to commercial to business financing. Extensive experience, millions of dollars closed, all the good stuff. So very happy to sit here with Wanda after another successful deal with her and her investors. So I'm ready to get into it. Very excited.
Awesome. So I'll tell everyone briefly, I met you because you and I just did a deal together. And for those of you that are watching, I'm actually licensed in Georgia, Florida, and Alabama. And I recently had a deal that closed in Alabama, and you were the loan officer for it. And my client, he spoke highly of you, the buyer. And I was I was amazed because the transaction was under $100,000. So I want to talk about that first because a lot of the lenders that I work with on your traditional loans, they don't do loans for under 100,000. So why is that?
So that's actually a great question because I run across investors looking for under $100,000 loans, whether it's in Alabama, Georgia, Pennsylvania. All of these places have Ohio property values under 100,000. And reason people don't typically lend under 100,000 is they don't see the time, money, return on those
Mhm.
type of deals, and they just don't have the lending capacity to do those type of deals. Good thing is with Blakemore Mortgages, we are a direct lender, so we have the capabilities to direct lend on those deals through our investors line of credit, and we're also a broker, so we work with over 90 different wholesale lenders, hard money lenders and such, to make sure any deal that comes to us is able to be financed with us. So when we were brought that deal, that was just another deal that we didn't think too much of. We have no
Mhm.
minimum out. So whether it's under 100,000 or it's under 75,000, right? We make sure we get
Yeah.
it done for our investors, because one thing that I don't want my company to be is, hey, we only want big loans. We only want to work with the big institutional guys, right? I
Mhm.
work off of relationships, building relationships, and those guys, that may be purchasing under $100,000 properties, they're buying 10 of them a month, right? So you
Mhm.
have
Mhm.
to be able to service all of the clients that come in the door.
Awesome. Well, that's good to know. So, those of you that are watching, if you are in need of a loan, any loan, obviously, he can service anyone, but definitely under $100,000. Like I said, it's not common. So, make sure that you reach out to him. So, let's talk about this. So, like I said, a lot of my clients, their loved one has passed away, and sometimes the situation is like this, Emmanuel.
Mhm.
Um, the maybe they haven't paid the mortgage and they're facing foreclosure, and I'm in a position where I have to quickly sell their home, or they haven't paid their taxes. And then sometimes these people, they, like I said, they want to flip the house, but they don't know what to do. So tell me, what is there a specific type of loan that someone would need in order to do an investment property?
Right. Okay. And just to clarify, we're talking about someone that's facing foreclosure or someone that's trying to buy a foreclosure. Those are two different things, of course.
Any type of investment loan, just any type of flip. I was just really just relating,
Gotcha.
referencing the different type of people that I encounter. The
Understood.
different, I'm sorry, the different type of situations.
Understood. Understood. So yes, that's a great question. There's very nuanced loans when it comes to the rehab sector, right? When you're thinking of rehab loans, you're thinking of bridge loans. Okay. Those are short-term bridge loans, or some people call them hard money loans. Okay. So
Mhm.
people get confused with what is hard money, right? That's exactly what hard money is. It's those rehab loans, okay? And unlike a typical, let's say, an investor rental loan or a multifamily or even a commercial loan, right? These investment loans that have a rehab component are going to be kind of two separate baskets, okay? So you're going to have your basket A, that's for your purchase, okay? So you're going to have a certain loan just to help you purchase the property. Now, the other hand, you're also going to have a loan for the rehab on the property. That's the second component. That's your escrow, okay, account. So at closing, you know, let's say you're very seasoned in this, you have great credit, you know, this is something that you don't have any qualms on, you know, diving right in day one. We're going to be able to finance you typically 90% of the purchase price on that property and 100% of the rehab on that property. Okay. So what that is of course, 95 loan to total cost, 95% loan to total cost. So you're really only going in with 5% of the total cost of that project, which makes it very, very beneficial when you're going and you're getting a property that's under the 75% ARV. Okay. Because we want to underwrite these properties expecting the ARV to come back, you know, typically, with a 25% net gain. Okay. So
let me ask you this, because what if someone doesn't know what ARV is? What is ARV?
Great question. So ARV exactly is after repair value. Okay. And it sounds just like what it means, right? After you repair the property, what's the thing worth? You know? So with that being said, we're basing our loan as well off of the ARV. So not just your purchase price and the appraisal on that property to begin with, but we're also going to base it off of what the ARV is. Typically, we don't want to loan on a property that we know is not going to work for you. We're trying to protect ourselves while also protecting you from going into a bad project. So when we underwrite that project, when you hand in the rehab budget, which we're going to need to see, right? You hand in the scope of work, which we're going to need to see, right? We're going to be looking at that purchase price. We're going to be looking at the area to make sure that the ARV is realistic, because if you're buying a property out in, off the dusty old trail, you could put $100,000 worth of work into it. You might only get back $110,000 worth of work, but you're thinking you're going to get $200,000. And, sometimes I have to sit investors down and, we look at the deal and we underwrite it together to make sure that they're really going to be successful in this, because, once again, I don't really focus on selling loans. Where I really make my money is advising and making sure that they are getting the end goal that they have seen and that they want to, reach, So just to get back on the technical side of things, 90% of the purchase price, 100% of your rehab cost. And then that has to be no more than 75% of the after repair value of the property. Okay. And once again, with that second account, just to go into a little bit of detail on that escrow account, you're not going to get all of the rehab funds at once. Okay. What you're going to have is draws. Okay. Typically, between 4 to 6 draws. It depends, how extensive the rehab is. But what you're going to have is an escrow account that is going to be drawn upon as the rehab continues. So the lender's going to be tracking the project, making sure that you're on it. You're not you're not just giving the money and say, hey, fix it up. We'll be back. We're watching, making sure that the rehab is getting done for you to get that 100% rehab cost. So when the rehab, let's say you put in new flooring, once that flooring is complete, right? The GC is going to call the lender, they're going to let the servicer, and they're going to let them know that the rehab's complete. They're going to send an inspector out. Inspector's going to look, okay, new flooring. Okay, it matches the scope of work, cost, get the invoices, and then they release the wire to the GC to pay for the work. So they're walking the project the entire time.
And so the wire goes directly to the GC, not to the buyer. Right, to make sure that person gets paid.
Exactly. And they're sticking to budget, because as an investor, you're thinking it costs one thing when the GC knows exactly what it costs because they're doing it, day in and day out. But the good thing is, as those, you're not paying any payment towards the undrawn amount. So as the loan and the project continues to get completed, you're going to have a larger monthly payment because you're paying interest only on the principal, which is the purchase, that 90%, and you're paying interest only on what is drawn from that earnest money. Okay, because it's Dutch. So you're only paying on draw one, and then once you draw the second time, now you're paying on draw 1 and 2. Now you draw a third time, now you're paying on draw 1, 2, and 3, interest only, until you reach the balloon payment at the end of your 12, 18, 24 month term.
Okay. Is there a penalty if they pay it off early?
No, these loans have no prepayment penalty. I honestly encourage my investors to get the project done quicker, as quickly as possible, right? Because there's no prepayment penalty, and the holding costs associated with having a property, paying property taxes, paying the loan, paying all the main, just the upkeep of the property cuts into your cash on cash return. So it really behooves you to get the properties in and out like a revolving door as quickly as possible. Now, don't cut work just to get a project done, but do it speedily and efficiently.
So someone who has never flipped a property, has never done this, does that person, I guess I'm asking this question because I know people that have mentors, and if they take the person that has not done it, if they bring them to you and they tell you, hey, I'm mentoring this person, then they get better treatment. How does that work?
So if you're going to bring a mentor in and they're willing to sign off on the project with you, we do give an account experience. So unlike, even, rental loans are a little bit different. Unlike most of the loans, you're going to be actually underwritten based off of your previous experience doing this. So if you only done one project, your interest rate, of course, is going to be higher than someone that's done 6 projects in the last 3 years, because every loan that we're drawing up and we're giving terms for, we're basing our terms off the risk factors associated with the loan. How risky is this person and this property that we're investing in? Okay. Mixed together, right? So, it's not one over the other. It's a mix, Of course, if you bring a great project, knock it out the park, that's going to be easier to finance. Just like if you had great credit, it'd be easier to finance a not so great deal. So give and take there. But going back to your original example here, if that mentor has done 5 projects in the last 3 years and you've done none, that's going to completely change the terms that you're going to receive. Did I lose her?
Yeah, you're back.
All right, I'm back. Sorry.
Yes.
Shut off. Just because you're going to be looking, and we're going to be looking at the experience of that investor, kind of, watching your back, making sure that you're doing the right things, hitting on timelines, knowing what to rehab and what not to rehab in order to get a certain amount of sweat equity back. Those different things, nuances that you don't fully understand, right? It's like, reading how to learn how to ride a bike and actually riding a bike,
Right.
It's two completely different things. So, as a lender, we know that, and we know that there is always a chance for a deal to unfortunately go left, and everyone loses money in that case. So when bringing someone with experience, it 2x's the betterness of your terms to give it a better, it's a completely different ball game, But as you build experience as a rehabber, and you get that one project, done with your mentor, the next one, you can sign off on yourself, when you have good credit and all those things. So it gets easier as you go, but the barrier to entry is that experience typically.
Awesome. So So these investor loans, what is the loan process look like? What is the credit score minimum? What does the income verification look like? We did talk about the down payment already. What does the application process look like?
So with these specifically hard money rehab loans, application is very quick. It's a short application. You're gonna, of course, want to tell us, the experience, your plans for the project. We're of course want to know the scope of work. Okay, so we want to know what you're gonna be doing, right? You want to know the rehab budget, how much it's gonna cost, right? We want to know the property,
Mm-hmm.
right? Where the property is located, the area is located in. We want to underwrite that. And then, of course, you as well as the guarantor, we need to know about, right? We need to know about the financial backing behind the loan, even though we care more about the property. So we're going to want to run credit, right? We're going to want to look at a quick, easy application to see, are you, are you liquid, right? Are you able to, if something goes left, to come out of pocket for anything? Because God forbid you go over budget and now everything's broken because you only had $100 in the bank and we didn't underwrite to see if you had assets. So, net worth, liquidity, those things are some of the things we'll look at. And then, as the loan, gets underwritten, we'll be able to process you term sheets. You will be able to review those term sheets from our different lender partners. And once you are, able to say, hey, these terms look all right to me, they look great, I think we should move forward, you sign off on the term sheet, and then we begin the submission into the actual underwriting of the loan. Very similarly, if you're just looking at purchasing a regular rental property or single family home without a rehab component, you'd be looking at a DSCR loan. Okay. And those loans are even easier. We only really need a driver's license. We need to see that you have down payment, closing costs, and typically 3 to 6 months reserves, depending on the credit. And then, a short, easy application. We don't really even need a lease in place. We could go off of market rent, and that's all it takes. And then we close it in 14 days. So those loans, the rental loans, are a lot easier to get into, especially with no experience. But rehab typically is going to take about 45 days to close because of the extra components we have to underwrite.
So when you say rental loan, you mean someone is going to purchase a property to put a tenant in the property? Is that what you're
Correct.
referencing?
Yeah. So
Okay.
a rental loan is going to be where they're going to purchase the property. We do not look at the income of the guarantor. That's mute. Where we're going to be looking at is the potential income of that property. We're going to underwrite the loan based off the DSCR of the property, or debt service coverage ratio, which basically is going to be your income versus the debt on the property. So just to make it easy, if your mortgage is $100, we want to see that the income or the rent on the property is $100, and then you qualify for the loan. So something like that, once you get the market rent back or you get the lease agreement back, you qualify for the home once you have your down payment and closing costs. Super easy, and can turn those around very, very quickly.
Okay, so back to the investor loans. Is there a minimum credit score?
Yes. So we can go as low as a 620 with the experience on most investor loans. If it's a rental, definitely 620. As you get into more of the rehab loans, right, the fix and flip loans, as like people like to call them, those are going to typically, terms get really choppy at 680 and below. We can get it done. Like I said in the beginning, right? If you come to the door, we have the capabilities of getting it done. But under 680, I want to see some serious experience. I want to see a great project. I want to see something that's, a diamond in the rough, right? That you happen to find and your credit just so happened to get messed up recently. But typically, as an investor, you should have 700 plus credit. You're an investor. There's no reason you shouldn't have 700 plus credit. If you don't take care of your credit, how can we assume that you're going to take care of our property, right? Because until you pay us back, that's our property.
That's right. Look, preach. Okay, let's see. Okay, here's my next question. So, back to my probate. If I have two siblings, Emmanuel, and
Mhm.
grandmother passed away and left both of them the house. Well, one wants to doesn't want to sell. One of them doesn't want to sell, and the other wants to sell and possibly flip the house. Is that possible where one can buy the other out?
For sure, for sure. And are they still in probate?
They're out of probate. We have the paperwork to make it happen from the
Okay.
judge. It's been
Yeah, very
approved.
easy. Very easy. So, you know, all the heirs, of course, are going to have to sign off on a buyout. So just as if like you're buying out a partner in an LLC, right?
Mhm,
You're going to buy out the family member in this probate situation. So what's going to happen is you're of course going to typically need a vote on it. If it's in probate, you're going to have the court vote on it. If it's in a trust, after probate, you'll have, all the beneficiaries vote, and then there's typically someone in charge of the trust that'll count the votes and then say, okay, we can sell it for this market value. So
mhm.
that's typically how it goes. They agree upon a market value, or they'll run an appraisal, and then they'll vote on if they'll pass that property on to that person. And then what happens after that is very simple. So that the one sibling that does want to purchase the property, they're gonna then go to qualify for the loan or the buyout loan. Okay, so
Okay.
let's just say it's a regular rental property. They don't want to live in it, right?
Mhm.
They just want to lease it, right? They want to own it, get some cash flow. So what they're gonna do, let's just say it's a 300K property. They're gonna go and they're gonna qualify to get the 300K. Okay, so probably with a mixture of down payment and everything, that's gonna get them a 300K loan on that property that they're technically purchasing from the trust or the estate. Okay,
Mhm.
now after they purchase that property, they're going to have to pay out or buy out the other family members on the trust. So there's
Mhm.
going to be an agreed upon amount. So if the property is worth 300,000, and like you said, there's one other sibling, they're typically going to split it right down the middle, unless they have some other negotiations. They're going to
Mhm.
split it down the middle, and at closing, $150,000 is going to go towards the sibling, and then the rest of the equity is going to fall with the now owner sibling, and they will gain full control of the property on title. So they
Mhm.
simply just buy out the ownership interest of the other party with the loan, just
But
as if they were to split an LLC.
but the key thing here though is that that sibling that wants to purchase it had to qualify for the 300,000, correct?
Yes,
Yes.
correct.
Right.
By themselves.
Not just their 150. They had to qualify for the full
They
amount.
have to full amount. But the good
Yeah.
thing is the rental loans, like we just talked about, we don't care what their income is. So as long as they have the credit and that property has a good enough income on the lease agreement, we can
Mhm.
make sure that they qualify for whatever amount they're looking for. And if they can only qualify for half of that, and that's when you run into issues. Then it's not a good rental property. So now we want to, once again, a lot of these underwriting tactics are to save you guys, not to save us. We're partners in this, right? We're co-owning this property. We're putting a lien on the property that you own. So if it's not debt servicing and you're going to be losing money every month on that deal, once again, Blakemore Mortgages, we have the capabilities to get it done with no ratio loans, but that's a red flag. That's
Mhm.
going to give you a higher interest rate because it becomes more risky.
Um, it's interesting to me that, and I didn't know this until you just said it, that with the properties where the person is going to put a renter in it, a tenant, that if I'm doing it, my income doesn't matter. What you're looking at is the rental income that they're getting. And I'm gonna tell you why that's interesting to me, because I was reading an article, Emmanuel, in Georgia. They were
Mhm.
saying that there are currently three big companies that own like 30% of all of the rentals in the metro Atlanta area. So it's
Really?
like they're taking over.
Wow.
So to hear you say that, somebody like me could be that big company because my income doesn't matter, it's doable. But if people don't watch videos like this to get the knowledge, then we don't know that.
Some very unfortunate, or talk to their professionals. It's just searching things on Google doesn't always get you in the right rabbit hole.
Right. Yes, Google will mess you up
Yeah,
sometimes.
that's for sure. That's for sure. I've had clients come to me and say the craziest things.
I'm sure.
Did you hear that? Who told you that?
Yeah. And another one now is Chat GPT. Oh, Chat GPT said, it's like,
Oh my
okay.
goodness. ChatGPT learned in 2023, as far as the real estate and the banking and lending, we change daily,
Yeah.
weekly.
Yes. Yes. So true. So you mentioned sending inspectors out when the person has the loan with you. How do you have your inspectors? Are these work for your company? How does that, what does that look like?
So typically after the loans originated, the loan is sold to a servicer, and that servicer is going to service the loan. They're going to service the loan for the life of the loan. So they're going to take care of sending inspectors out. They're going to take care of making sure that, the draws are released and everything like that.
Hmm.
So with the inspector and everything, that's going to be a third party. GC will have the number, and believe me, the GC knows how to get their draw money. They're going to make sure they get their money. So
Yeah.
as an investor, you don't have to worry. They're going to make sure.
Hmm.
But yeah,
Awesome.
that's simple enough.
What states do you service?
So on the commercial side or business purpose side, so those are going to be your rehabs, your rental properties, all of those different things. We're going to be able to lend in at least 40 states. Okay.
Okay.
Some states it's a little different with their regulations, so it makes it harder to lend in on those types of deals. But we're trying to make our way to all 50 on the commercial side. As far as residential owner occupied, we primarily only lend in Florida as of now. We may be extending up to Georgia and Alabama this year.
Okay.
We keep working with you, but
Yeah.
primarily owner occupied, only Florida, but commercial, we're all over the country.
Awesome. So what is your contact information? Give your phone number and your email, even though I'm going to put it in the description area for everyone.
For sure, for sure. So everyone could reach me at my phone number, call, text 305 All right. And if you want to reach me by email, you can reach me at info at Blakemore. It's just how it sounds. Blakemore, mortgages, all one word, .com. And we'll be sure to get to you within, 24 to 48 hours.
Awesome. So before we end, is there anything else that you want to share? Anything I may have missed?
As far as the investor side of things, I think you touched on a really great point. A lot of people want to point the finger at the big hedge fund companies or the big, REITs, real estate investment trusts, their hedge funds, right? And, they're not the bad guys. They're just playing the same game that you're doing on a bigger scale. I come from, working with those guys. I worked in capital markets for quite some time. So, at corporate debt advisory, you're working with the REITs and the hedge funds and the trusts and the different, big conglomerates that are buying up these properties. And, I can tell you right now, all the deals that I was looking at, they're not really looking at these small single families, duplexes, triplexes, quadplexes. They're looking at buying a hotel. They're looking at buying a retail strip. They're looking at buying a mall, something that's going to get returned to their investors in droves. They're not looking to buy up 100 single family homes that they have to manage or flip.
Yeah.
it's just so minute details. So I think when it comes down to it, media may portray as, hey, all the single family homes are getting bought up. And there may be, like you said, in certain markets like Georgia, a big concentration of these big companies buying these homes. But if you're dedicated, you learn how to underwrite, you work with a trusted team like us, right, to get you over the hump, there are so many deals out there for you to take advantage of. It's just, it's insurmountable. You don't even understand how much opportunity is out there because you're not looking for it. You're looking at why there is an opportunity. You're missing out. I just had an investor in Pennsylvania, Pittsburgh, West Pennsylvania, purchase 5 units for $200,000. I had it fully rented out, cash flowing day one. And under 100,000, there's tons of properties out there, and you don't have to qualify with your income, as we spoke about. So, if you have, $10K saved up and you already own your owner occupied, don't use that on the new car. Don't use that on the new pair of Louis Vuitton shoes. Don't
right.
belt, right?
Right.
Let's take that money and you can get a good investment property. I'm not talking about some slumlord investment property. I'm talking about a good deal in a good market, as long as you're looking for it. The problem is those hedge funds, those big guys, they're looking for it because they want to give a return to their shareholders. You have to want to give a return to yourself as a shareholder for yourself, your company, and your household.
That's right. Your family. Yes. A legacy. Yeah.
Exactly.
Wow. Awesome. Well, that was a good closing. I was about to say preach again.
No,
thank you for joining me, Emmanuel. I'll say this, that the transaction I had with you was amazing. I'm a stickler with lenders, and you were on point. I told you, you were on point.
I had to be. We always are, so I wasn't too worried about it.
I appreciate it. You and your team were on point. So thank you for being here. Thank you everyone for watching. Again, my name is Wanda Rochelle, and I am a licensed realtor and probate specialist. So if you are looking to buy, sell, or invest in Georgia, Florida, or Alabama, or if you need a referral in any other state, I'll be glad to assist you with that. And I'm grateful for Emmanuel. Please reach out to him for your lender needs, and I'll see you on the next broadcast.
All right. Thank you, guys.